Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with our colleague Alan Gula, senior analyst at Stansberry Research.
And for today's rant, we'll talk about tech layoffs, the debt ceiling crisis, and more.
And remember, you can email us at feedback@investorhour.com and tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. So I'm looking at some stats here at layoffs.fyi, and they list the biggest tech layoffs since COVID-19. And the top ones are Google, Meta, the top six. Google, Meta, Microsoft, Amazon, Amazon again, and then Salesforce, all since November. Wow. And it totals 57,000, as I read here. 57,000 people in these companies. These are the companies that you've seen these like TikTok videos where they go to work and they show you basically, I work at a resort called Google or something, right? I work at a resort called Meta, and they have all these incredible foods and services and anything you want. And their job looks like a piece of cake the way they represent in the TikTok videos. So my point here is that these companies, like, their employees are a huge investment, and they're looking for the best of the best. Now, I'm not saying that all the people got laid off. If you're going to lay people off, you don't lay off the best of the best, right? But overall, they spend a lot of money to get these folks, and now they're laying off 57,000 of them. I think this is a harbinger. And Microsoft, when they did their big layoff a few days ago, they said, it's the slowdown in the global economy. Like, there's no ifs, ands, or buts.
Yeah, like you said, Microsoft was the most recent one. They laid off 10,000 employees this week, cost-cutting measures, basically. And, Microsoft's the CEO made this announcement from Davos, by the way, which is probably nice for those employees that back in Seattle or wherever they are. And
a little tone deaf there, buddy, but okay, yeah.
But the point being, these tech layoffs are still happening, because obviously these companies are going to try to keep their margins up and beat Wall Street expectations and whatnot. So, and I heard a comment today, actually, that the tech industry isn't even at, they're still above full employment, like generally speaking, that the tech industry. Right. So there could be some more room to go here, I would think, if that number is true. And, a harbinger of things possibly to come in other industries like we've been talking about the last couple of weeks,
And even to come in tech, like if you look at the other stats at layoffs.fyi, you will see just layoff after layoff after layoff. They list the companies, but they're really small. I've never heard of any of them, and they're laying off 100 or 50 or 200 or 20 or the number. They don't even list the number. It's just some little company you never heard of. I think the ripples are already feeling this. And the most recent one, by the way, was actually Google, 12,000. So just recently, that's like 22,000 in the past few days.
Right.
Boom, no job. And they get a few months severance, and they get, again, treated really well. And maybe somebody out there is going to tell me, but this is good for margins. Generally speaking, but, Microsoft would rather keep these people and see their business grow and not be hampered by what apparently they're looking at maybe some type of global recession or something. So not good. And I think worse maybe than the average market participant is thinking.
I think so.
Yeah, not a lot of bearishness out there that I'm seeing.
I know. I was thinking about this today. I'm getting increasingly more concerned than I was 2 months ago, just because the amount of optimism that is out there. I would love to be more optimistic about the markets and the economy, but now you're starting to see these layoffs continue and maybe pile up even more.
Mm-hmm.
You're starting to see some other numbers pointing to serious economic slowdown. And then at the same time, you're hearing the Fed officials getting nervous and saying, we're going to go to 25 basis points instead of 50. They're already pulling back faster than they thought they would, or talking about doing it than they thought they would. So, So anyway, I'm getting a little more concerned now that, to your point about maybe the average market participant isn't. I can't speak for every market participant, but I think I'm getting a little more, not scared, but concerned maybe than some other people.
Sure. Yeah, I think you're seeing the same thing I am. It's like, wait a minute, where's the bearishness again? Because you still, that's
Where
still,
did the bear market go?
yeah, that's still sort of a narrative, is that, people are so bearish, but they're really not, that I can see. I mean, like Bed Bath & Beyond, they got warned past couple of days. They were warned by the NASDAQ. They have, I think, 60 days to get in compliance by filing their 10Q. They're late on their 10Q. And what do you do when you're busy filing bankruptcy? Well, let's just not worry about the 10Q right now, because it's about to become totally irrelevant. And the stock is still like, I think the market cap is hundreds of millions anyway. It's still $3 or $4.
Yeah.
And it should be pennies by now. It should not exist.
Yeah, they're closing hundreds of stores.
Yeah.
It's yeah.
Yeah, the last wave is like 130 stores. I mean, just like not really, it doesn't look bearish to me. And Tesla was another one. Like, finally, after all these bears talking about fraud at Tesla for years now, their director of whatever, self-driving, I forget what his title is, but he comes out in a Reuters story last week and says, hey, you know that video we had of the self-driving Model X in October 2016? We faked it. The car doesn't really have those features. It doesn't really stop at red lights and go at green lights, et cetera, et cetera. And I mean, I don't know if this is going to blow up into something bigger, but the stock is up like 3 or 4% on the week. I mean, it's just like, that's not bearish.
Right. Yeah, when the bad news is still good news.
Yeah.
It's still not bearish yet. Now, we saw a little bit maybe last week about, when these retail sales numbers came out, that was a little bad news becoming bad news, as far as, I think it was 1.1% decrease in December in the U.S. after another month of decreases in November. The market reacted badly to those numbers, but I think, on balance, there's still these pockets of froth. I mean, when you're talking about Bed Bath & Beyond, like, has anybody been to a Bed Bath & Beyond lately? Like, it's not, you don't get that warm and cozy feeling there. So it's
downright awkward.
Yeah. And so for the stock to be performing the way it is, I mean, that's just kind of residual, I feel like, from the meme, the peak meme era.
Right.
And people are still hanging on there.
Yeah, I mean, I saw a really, really sad tweet of some poor guy who's apparently long Bed Bath & Beyond. He's like, come on, guys, let's pump this thing up to the moon, just the same way everybody was doing during the meme stock era in 2021. It's just sad at this point. The thing is headed for bankruptcy. We all know it. Oh.
Yeah, that's like being too late at the party,
Yeah, yeah.
Unfortunately.
Really sad.
Yeah.
So, I think the tech layoff headlines are sort of the opposite of noise. It's not loud enough, like people don't quite get enough. At the other end of the spectrum is like almost pure noise, which I would categorize the debt ceiling. The debt ceiling crisis. I'm making air quotes, folks.
Yes, I would too.
Debt ceiling crisis in quotes.
Yes.
What do you agree, disagree?
Yeah, as far as it being pure noise and an immense amount of noise. Yeah, I mean, all you need to do is look at, we're talking about this because it's been in the news again lately. The politicians bringing up the debt ceiling raise or suspension or whatever you want to call, it. The debt ceiling's been raised almost 80 times since 1960. So if you think it's not going to happen again, that's not a good bet. First of all, and people are going to make this is probably going to go on for another 3 months or so. Some debate about it, mainly from politicians using it as some sort of leverage or talking points. And I was literally looking up what I wrote 2 years ago about when this happened the last time it wasn't even 2 years ago, it was 2021 when they were arguing over the debt ceiling. In the end, the debt ceiling is going to be suspended or raised, and there'll be more debt in the system. The U.S. cannot survive without it. I mean, you're talking about treasuries, defaulting. Nobody's going to get to that point. No. I think Janet Yellen has a form letter at this point that she sends out about what's going on. I think from 2 years ago, it was almost the same exact thing with some names changed. Democrats, Republicans. It's all the same nonsense.
It is. I completely agree, and it's just so absurd. You've got the world's reserve currency. There's more demand for dollars. I think there's a lot of demand actually out there for dollars, and more on the way. And it's hard to sell anything in this world without getting dollars. And that being the case, like, there is absolutely no political reason. It's politically totally not feasible at all that the United States would default on its debt, which, if they run this thing out, they technically go into default. I think they might lose another notch on the credit rating. They went from AAA to AA plus, the last big go round in 2011.
Yeah.
So maybe they take them down to AA, but who cares? It's still the US dollar, and they'll raise it because they have to, because the people, they'll see the political reality. You can't be the guy who held up the process of raising the debt ceiling, push the country into a crisis. No matter how much you think it's the right thing to do.
Right.
It would really so quickly look like the insane thing to do, politically at least.
Right. Part of me always thinks, when this came up the last time was, maybe somebody is dumb enough in Congress to just let this happen. And if it does, I think those same people in DC will quickly realize what a mistake that would be just for the system in general and them, maybe at that point it'll sink into them. Yeah. But I would never rule out anything as 0% risk.
Oh, right.
But
there is a non-zero probability.
There is a non-zero probability. But, however, it's history suggests more of the same with the debt ceiling. So no matter what you hear about the debt ceiling, they already pushed it back to the next deadline about negotiations till April. So that'll probably happen again, and it'll be by the end of the year. I think what happened last time is they got to the end of the year, and and some of the budget bills and whatnot, then it became fixed, which basically raising the limit. So
I forget what they have a special term for the day, when we sort of go into default and everything ends, but sometime in the June-September timeframe is my understanding, when it just gets so insane that there's no way they'll go through to September with this, I don't think. And the whole thing, it's pure political noise, but it does create some noise in the bond market, which might give you a nice opportunity to enter. The question becomes, do I really want to try to time this? Okay, we're pushed out to the April deadline now. Do I want to wait until, halfway between here and there? Because one would think that, in the second half of that period, we might start getting the idea that, no, we're not insane enough to do this, to let this happen.
Right.
But we'll see. I think at some point along here, there's going to be a dynamite moment to buy bonds. Timing it is probably insanely difficult, but I don't think you have to pinpoint the bottom. And you can't do that anyway, but you don't have to. I think bonds were beaten absolutely to death. Literally, the U.S. Treasuries had their worst year since 1788. According to the Deutsche Bank data, I saw some Bank of America data that puts it at 1796. Okay. So I'm going to let those people argue about, 8 years, whatever it is. But let's just call it 18th century. You know what I'm saying?
Yeah.
I don't think we're going to get a second year in a row of worst performance since the 18th century. And that might be all it takes.
Yeah, you don't need much more,
So there could be an opportunity here. Also, I think there could be I just get this feeling, and it's partly based on looking at charts, which, I'm practically a voodoo witch doctor when it comes to looking at charts, but I think it's useful when I look at stuff like copper and gold stocks and copper stocks and things. I think, man, they don't make me feel like a contrarian at all, because they're really pushing up against the recent highs, but I feel like they're getting ready to launch. Which is a weird way to feel when you're talking tech layoffs and global recession and all this stuff. So there's danger and opportunity here.
Yeah, I agree. I'm with you on gold right now, too. I think things are aligning for gold in terms of monetary policy and risk and the dollar, what's going on with the dollar weakening a bit. And the more I think about it, the more gold is perfect right now, because the dollar's weakening. We talked about this a couple weeks ago. Yeah. Gold had already been making highs in other currencies, or versus other currencies. Then I think inflation is going to stay higher longer. So if you have a weakening dollar and inflation staying higher than usual for longer, I mean, gold and those kind of hard asset type things, I think, like you said, this is like a different, we're in a, Howard Marks called it the sea change. This is it. This is like, this is what's happening. These things, tech companies are laying thousands of people off, and gold's going up. So what else do you need to see? It's a different time. It's very interesting to me. I mean, this could be a fun kind of year if you're plugged in. And
I agree, and it's interesting to me. Like, I feel slightly insane, but I know how these things go. Like, I want to be long dollars and I want to be long gold at the same time. Oddly enough, like, just think of the dollar's price as being reflective of euro, yen, and pound, and I think of gold's price being reflective of dollars. So the dollar can actually weaken versus gold and be strong versus the others.
Right.
So like Dixie, the dollar index is simply the dollar in those other currencies proportionally. It's like 57 or 58% euro, et cetera, et cetera, et cetera. It's really almost entirely those three. So you get this weird sort of thing where maybe the dollar and gold rise together. And I don't think you're insane for wanting to own both. Certainly in the Ferris report, I'm like, yeah, we just bought dollars in a good way, and we've bought gold, I think, in a couple of pretty good ways. So we're ready, man.
All right.
We'll see. If things happen the way,
we'll check back in a month.
Yeah.
Or
give me more than a month. But we will check back.
Yeah.
Interesting year.
Yeah, it will be one way or another.
Yeah, it ain't 2019 anymore, Buttercup. It's it's different now. Certainly not 2021 or 2020. Latter half of 2020.
And let's hope not 2022. Yeah.
Yeah.
It is fascinating. You wonder what I still feel like everything that happened in 2022 is kind of just advanced, kind of fretting and warning about the Fed and inflation fighting. And now still, I don't know. I don't think that a lot of whatever is going to happen in the middle of this year, the end of this year, is still, like, if you look at the bond yields and whatnot, people believe the Fed is going to come in later this year and cut rates still. And to this point, they've still have done nothing but the opposite of what those same people have expected.
Yep.
So I don't know. To me, I'm still on the relatively conservative side, but still seeing opportunities out there, I guess, is my point at the beginning of this year.
Yeah, I think that's a decent posture, but I'm starting to look at the situation and think, these 25 bips raises that we think are coming, are there going to be two of them, or are there going to be four of them? Yeah. And after there are, let's say, two or three of them, would there be no action for one or two meetings and then a cut? Because like the lag here, and I've said this in other places recently, but I'll keep repeating it. The lag component is like twice over, because when the Fed announces policy action, it's looking at the data backwards, and the data's lagging, and it's looking backwards at that data. Then it's executing monetary policy at that moment, which itself has a lagging effect months and months into the future.
Yeah.
So that moment, months and months in the future, is months and months before the monetary. It's like way off.
Yeah, it's like this cat and mouse game. They're playing catch up to themselves, playing catch up to themselves. Yeah.
So is this really at this moment in January 2023? Are we saying that this moment discounts or is what we what the 75 bips, the simultaneous 75 bips cuts, it was about this moment? Or are we still not there yet? You see what I'm saying?
Yeah. Yeah, that's what I keep thinking too. Are we not there at that, we're waiting for these lag, they say all the time, these blunt tools, the lag effects, what are we, and then at the first sign of slowdown, they're saying we're pulling back. So maybe there's something to be said that, for the end of the year, we might have some sort of cut. But again, if inflation is what it is, and like we've said before, those numbers with the housing market, that rent number is, that's still going to be higher than usual. So I don't know. It's going to be interesting towards the end of this year, or obviously the next couple months, probably all of this year, really. If there's no real, sometimes I feel like you kind of can see generally speaking, where the Fed might go, but I don't right now.
No. As a matter of fact, this is important. Up to this point, you've been able to say, okay, They said they're going to be more restrictive. They said there's going to be pain, and they keep making these interest rate hikes. And it was like 75 bips. I mean, they kept coming with the 75 bips. I was like, whoa, they're serious. Their words and their actions are lining up. But now we get to the point where you're going to have to go back into a much heavier parsing of Fed speak, right? Maybe. I'm guessing that in the next couple of meetings, the next couple of monetary policy actions, you're going to start hearing some different talk, and then you're going to have to scratch your head and say, okay, that wonderful reverse negative Goldilocks period where you knew they were going to hammer with hikes and hikes and hikes. Maybe that's over. And now what? It's an interesting moment.
Agreed.
All right. So let's talk to an interesting guy, Mr. Alan Gula, our colleague, senior editor here at Stansberry Research. I cannot wait to talk with him because we've never done so. And I consider Alan a really fantastic analyst and just a great guy. So let's talk with him. Let's do it right now. Many mainstream analysts are predicting that stocks will recover soon. But I say we'll instead witness a cash frenzy unlike we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation or any of these other things. As all this unfolds, the financial consequences of what I'm talking about could last for several decades if you don't understand what's happening. There will be winners and losers, and now is the time to decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone for a free copy of this new report. Alan, welcome to the show.
Thanks for having me, Dan. Good to finally be on the show.
Yeah, we finally got you in here. I've been wanting to do so for quite some time.
Yeah, I was just waiting until inflation had peaked so I could come on the show and flip you bullish.
All right. Hey, bring it on, man. If that's how you feel, we definitely want to hear more about it. Okay. Well, I don't know. Maybe we should start there because, I tend to think of you as this, serious bottom-up guy who does really kind of deep analysis into the companies that he writes about. So, it always makes me wonder how much does anyone who I think that of think about macro issues, and you bring up inflation. So maybe we should start there.
Well, I think that any good recommendation has a big macro tailwind. And, so I think cycles are crucial from a macro standpoint. So the business cycle, credit cycle, risk cycle, inflation is important. And so, I can give you an example of when we got the cycle right. And when I say we, so I work on Stansberry's Investment Advisory, which is our flagship newsletter. We call it that because it's our longest running publication with a track record back to 1999. And in that newsletter's model portfolio, we have these investment categories that our recommendations usually fall into. And one of them is America's Energy Renaissance, which we've been writing about for over a decade, far longer than I've been at the company. And so the best time to invest in the energy sector is during an oil bust. And so do you remember what happened in April 2020 in the oil market?
April 2020, sure. WTI went negative.
Yeah, so the front month crude oil futures contract went negative, and that was, for me, that was sort of the signal that we had seen max pain for that oil bust, and that we were on our way to a boom. But if you remember, at the time, most people thought that the majority of exploration production companies, the oil and gas drillers, were going to go bankrupt. So I looked through the industry. to find well-run businesses, doing the bottoms-up analysis, the fundamental bottoms-up research, and to find well-run businesses that could survive a prolonged bust in case I was wrong. They weren't highly leveraged, and so we recommended Parsley Energy, a relatively small oil driller in the Permian Basin in Texas, and so the boom actually arrived fairly quickly, sooner than I had thought. And Parsley was acquired by Pioneer Natural Resources, which validated our work. And we later recommended some other oil royalty companies, and one of them was Texas Pacific Land, and we actually just took profits on TPL last November for something like a 440% gain in 2 years. And so that's a good example of us getting the macro right, catching the bottom of the oil bust. And then we got the inflation. It's not like we foresaw such a massive inflation, but we were just following the cycle, being opportunistic, and it really worked out in the end. And so we could talk about views on inflation, but I think that it's sort of, any good recommendation marries both the macro and bottoms up fundamental research.
Sounds like a good recipe to me. So let's just talk about your bottoms up process. Do you do screens or where do you start?
Well, so we do screens. So we're big on capital efficiency. So for example, and capital efficient companies don't require a lot of CapEx to grow. So they scale really well and produce a lot of free cash flow and return a lot of capital to shareholders. And so every quarter we publish a capital efficiency monitor, which is a list of our top 25 technology and non-tech capital efficient companies. And so we source a lot of the capital efficient stocks that we recommend from that list. So that's an example of sort of a screen that provides us with some ideas, and then we'll go in and do more research, and we'll have a bunch of ideas that we've been working on, and then sort of get together. And this is really a team effort. So there's me and a bunch of other analysts that work on the flagship newsletter. But we'll get together and decide which ideas are most compelling, which are the most timely, and then we'll go and do more in-depth research, and then start the write-up or look for a lead story, which is something that I think that what we do is very much different than sell-side equity research, where we have our research is much more accessible to retail investors, and we tell these cool stories at the beginning of the write-up, and it sort of relates to the thesis. And it tells some history, ideally, and it's something that's meant to be memorable, and so people, we're not just giving people a bunch of tables and data. Right.
Alan, if I met you at a conference, I would say, "Oh, he's a buy-side guy. He's working for a hedge fund." To me, that's just like, you exude that kind of mojo, and it's intended as a compliment. Like, I hope you don't have a bad view of hedge.
No, not at all. I worked on Wall Street. That's where I began my career, and then sort of had this. I started writing. So after the financial crisis, I started writing a little bit, and even put out like a couple of reports just to people in the industry I knew, and then somehow I joined a financial publishing firm in 2014, and moved down to Baltimore, and then joined Stansberry Research in 2016. So been there ever since.
Yeah, and Alan, what did you see during the financial crisis, and what got you into starting to write about the markets a bit? I mean, where were you? Maybe for people who aren't aware, or because that's kind of a transformative time for a lot of different people. So how did it hit you?
Yeah, well, I was actually on the distressed debt desk at Barclays Capital when Lehman filed bankruptcy, and so that was it was a really crazy time going through that. It was after going back to business school. I was on a trading rotation. and I had some time on various trading desks at Barclays, and it was just just tremendous experience. And I don't know when I started writing, I just in high school I think English was probably my least favorite subject, and never thought, and I just hated writing, and I just never thought I would now be. So I think half my job now is writing, half is research, and so like it's just crazy to think, how I got here. But it's
me too, believe it or not. English was me too, believe it or not. English was not my favorite subject either.
Yeah, but it's worked out well, and I really enjoy what I do, and I think it's much more rewarding than where I was at in the sense that I started off in corporate advisory, and it was exciting and learned a lot, but it wasn't that rewarding. And so now I get to help everyday investors, manage their portfolios and help them navigate these challenging markets.
Yeah, they've become a lot more challenging. It seemed almost easy up to the top in 2020, and it was really hard for a couple of months, and then it seemed really super easy for a while after that, but it doesn't seem easy anymore. It wasn't easy all along, though, was it?
Well, I think we've gone through these massive cycles, and I think that you could have a macro view, but you just always have to be looking for opportunities, no matter what's going on in the world, no matter what's going on in markets. And I think that that's one of the things that I've really been good at. Just obviously you have your macro view, but you can't let that get in the way of looking for opportunities.
Right. So that's what you just said. It sounds like sort of the classic value investor, right? The classic value investor says, I don't care about the macro, and I will buy any security that is priced right at any time.
I would say I'm more of a growth at a reasonable price investor. So the acronym is GARP. So I'm somewhere between the growth and value camps. So I tend to stay away from deep value because as we've seen up until recently, value can stay out of favor for a very long period of time, and there's also the risk of value traps. And then the major downside of growth investing is, as we've seen in the past year, growth stocks just get demolished when there's during a bear market. And so ideally, I look for companies with solid growth prospects that have great underlying businesses, yet their stocks are trading for a big discount to their, say, 5-year average valuation. And then if the macro fits into that, great. But I do the fundamental bottoms of research, looking for those types of attractive setups, looking for long-term setups, and mostly in large caps and mid caps.
I get a powerful whiff of Howard Marks from you, a former distressed debt guy who is very aware of cycles.
Yeah,
Marx wrote a whole book on cycles.
Yes, that's true. Yeah, that's right. Yeah, I've read some of his work. I think he's great.
Yeah.
What's your outlook now? I mean, you mentioned off the top kind of the macro with the oil bust in April 2020 and how that presented a great opportunity eventually, as we saw. What kind of areas do you see as kind of good areas for opportunities? Maybe some hated areas or that have good long-term stories.
Well, let me give an example of our most recent recommendation, and I'm not going to give it away because I don't think it would be fair to our paid subscribers, but I can illustrate why we like it. And so our newest category in the flagship newsletter is it's called Gatekeepers of the Financial Markets, and these are securities and derivatives exchanges, and they just have fantastic business models. They're often near oligopolies. There's high barriers to entry, so there's limited threat from new entrants. They benefit from network effects, not unlike social media networks. So the more traders on an exchange, the more each of those traders benefit in the form of tighter bid-ask spreads, more increased liquidity. and they have really, really wide free cash flow margins. And they're also recession proof. So risk and uncertainty cause financial market volatility, which drives up trading volumes, which boosts the exchange's fee revenue. And so these businesses are recession proof, but the stocks tend to get hit like any other when there's risk aversion. Right. So the one that we recently recommended was it was actually down. It fell 38% during the COVID crash, and at a time when volatility was spiking, and in hindsight, it was probably the best quarter the company has ever had. Or it was
incredible.
Objectively the best quarter the company had ever had. And so the market really gets these. I think it doesn't really understand these, or else there's just forced liquidation.
Mm-hmm.
But anyway, our latest recommendation, it's a leading futures exchange, but it's coming off a great 2022 with the volatility last year in terms of operating results. But the stock is now down again. It's down 30% from its peak, and it's about the cheapest it's been for the past 5 years based on the work we did, which was like a normalized free cash flow trend. And that, it's a solid business. It's a relatively slow grower, but it's just a fantastic opportunity to pick up this stock. And that's, I think, is a good example of some of the types of opportunities we look for. But I think, Corey, you're probably trying to get at where I think, am I bullish or bearish? Where's the overall market going? And I'd say, I think,
if you have an opinion, yes.
No, my opinion is not very strong right now. So, and I'll give the context, but I think that you really have to have some type of guide. And a few years ago, I developed a market valuation model because I was sort of tired of all the other models that were out there that, the CAPE ratio and the market cap to GDP and price of sales and forward PE ratios, all these market valuation models, they have these severe deficiencies. So I created a free cash flow yield model for the S&P 500, excluding financials. And this has sort of served as my guide for where the market is sitting from a valuation standpoint. And it's one of the reasons why I was bullish in March 2020, because the market on this measure, free cash flow yield, on this measure, the S&P 500 had gotten dirt cheap in March 2020. And so then, of course, we had that massive rally and the market got expensive. I don't think it was a bubble. I think, Dan, you would disagree with me last year. I think you've called it, just a mega bubble or whatever it was. And I think the market was expensive. I don't think it compares to the tech bubble in 1999, 2000. But anyway, I think now the model is showing that we're back to basically the average valuation over the past 25 years. And so prospective returns are not great. It's not like a time where I would pound the table and be bullish. But still, like I said before, you always have to be looking for opportunities. And we could see what the scary part is, if the market were to get cheap, we would be down, say, 17% from where we are now. If it got dirt cheap, we'd be down another 30%. And so that's the risk. But again, I do think inflation has peaked, and market's going to breathe a sigh of relief. As inflation continues to come down, the Fed sort of backs off its rate hiking campaign. That's sort of where I'm at.
Yeah, that's great. And Dan, that really, I'll let you guys can debate mega bubbles or not, but that fits with with a lot of what we've been talking about the last couple weeks, past couple months, really, on just, nobody really knows for sure where this is going next, but to weigh the possibilities of, if things get worse, it could be another 15, 20%, 30% down, but there's still places to make smart investments in the meantime that
Sure.
are beaten down already and have longer term stories behind them. So I think that's refreshing for maybe our listeners to hear as well.
It's funny because people are always trying to get me to debate like Matt McCall, and he and I sit down, and our view on things overlaps like 80%, and it's not a debate. There's no debating, and this idea of the mega bubble, it's such a rare thing. Like, I'll never tell you that it's supported by rigorous statistical analysis. It's a pure anecdote because there simply isn't. It's subjective, and there even subjectively there's not enough data points. It's just, it's hard to say. It's my opinion of things. It's not like I'm saying no, Alan's wrong and it's a mega bubble. And yes, I do get here tired of hearing myself say this stuff. I've been saying it for a year or whatever.
No,
but anyway,
Dan, to your credit, you called out. I remember was it early 2021, and that's really when you started talking about the excesses and Kathy Wood and and her arc.
Yeah.
And so
Arc was crazy.
And so I'd say that, and you've been dead right about that. And that's, if there was a bubble, it was in some of those stocks. And so I think that we're not on completely different pages. I think that there were some crazy excesses, and but largely those were outside the S&P 500.
While we're exploring all this, do you have views on crypto and Bitcoin and Ethereum and things?
I do. So Bitcoin has become just this risk on off asset, right? It's just highly correlated with the broader stock market, and so it's like if you're really bullish on the stock market, then you're sort of bullish on Bitcoin.
Right.
But I think I first looked at Bitcoin in 2013 and didn't buy it, and I'm kicking myself. And then I did do a lot of work on it in 2017. I bought some then, and so I'm a long-term Bitcoin bull. But it's like you have the 80% drawdowns, which is a feature, not a bug. And I think we're in a 75%, 80% drawdown, or we were. And so you've had 3 or 4 of those over the course of Bitcoin's life, and then it's like I think it's probably time to start looking at when another rally's another big bull market's going to begin.
Yeah, it's like Amazon on steroids, right?
Yeah,
multiple huge drawdowns. Everybody says, "Oh, it's finally over." Nope.
Right.
But of course, it's different, though, isn't it? It's I don't want to go too far down a rabbit hole because we could, but like I've never even been really sure that I understand truly what it is or why it has value. I mean, I know the characteristics. I can cite the characteristics, right? I can do what other people can do. But when I look at a really great business, like when I look at Costco, I think, oh man, this is beautiful.
Right.
It's like, I remember I researched this years ago, and I was looking at Walmart and Costco and a bunch of other things. And I thought, God, just one extra inventory turn at Costco. And, they have like 2 kinds of mustard instead of 50. There's so many beautiful details about it. I could talk about it all day.
Right.
But Bitcoin is like, well, I think I know the important details, but I don't have that visceral love of it like I do for a great business.
Yeah, I think the problem with Bitcoin is, or crypto in general, you had, besides the fact that there's all this fraud that's being uncovered, but anyway, I think a lot of crypto people last year, they sort of latched onto the inflation. They became these macro tourists, and it was like, okay, we're gonna have massive inflation, so that's bullish for Bitcoin, which obviously wasn't true. But but yeah, it's totally different. It's a speculation. There's no cash flows, and it's a speculation. It should be a very small percentage of everyone's portfolio, no leverage, and it's very different than analyzing a company. So
I said a moment ago that you reminded me of Howard Marks, and I'm going to go back to that, and even a little bit of well, let's just stick with Marx. And it's this idea that you are really, you seek a good return, a well-priced security with the aspect, with the characteristics and traits that you like. But we haven't even used the word very much. We always get here, so I'll bring it up. There's always this tight focus on risk. Tight focus on minimizing downside. And I hear you doing that through the bottom-up analysis, looking for good businesses that have growth potential, good financial condition, good competitive advantages, like you were telling me with the exchange, and macro tailwinds. That all looked at one way, that all sounds like lots of risk mitigation in your mind.
yeah, I think that's right. And when you were talking about that, it brought to mind so the sort of the minimum volatility anomaly, right? So it's like in the capital in finance, you have these models that sort of are supposed to predict how risky a stock is based on its beta, and the evidence is that some of the least risky securities, they actually have the best risk-adjusted returns and even higher returns than some of the riskiest securities. And it's sort of this anomaly that it just it doesn't go away. And so when you have these minimum volatility ETFs and funds, like USMV and ACWV, and that outperform over the long term. And so that's like a systematic way of carrying out the strategy. And so it's like sort of what we try to do on an individual basis, like looking for individuals, individual stocks that that have these attractive risk return relationships, but I'm not looking for growth stocks, and so yeah.
Without giving us a name, if you don't want to, can you just give us another example of something where you saw kind of the stars align the way you described your current pick?
The stars aligned. Well,
yeah.
So like into that early 2021, and the market was expensive. I don't know if it was a bubble, but market was expensive, and we were looking for picks, and we have to make a pick. Every single we have to make a pick, and so we went with Northrop Grumman, which is a defense contractor. They make inbound and outbound missile defense systems, and also rockets and spaceships, right? And so that was sort of, and I made the this analogy with the tech bubble. So in the tech bubble, you had obviously tech stocks were egregiously overvalued, but most stocks were expensive. And then you had aerospace and defense industry was in like a 40% drawdown during the tech bubble. So if you were always looking for opportunities, those stocks, if you bought those during the tech bubble in 99, 2000, you outperformed the market for a very long time. And so we sort of, it's not that it's not the exact same situation, but we were looking for opportunities, and Northrop Grumman was trading at, again, like a near a 5-year low valuation. That's sort of it's one of the things I look for, and so that turned out to be a big winner. So I think it was one of the top performing non-energy companies in 2022. We didn't predict the Russia-Ukraine war. We were just, and in fact, we had a thesis. It was the primary thesis was about the space race and how Northrop Grumman was the key to helping us win this next space race. But that's an example of where like you said, the stars sort of aligned, and it was a low risk recommendation at a time when the market was expensive, and it worked out well.
Yeah, that's a cool one. I would encourage anybody listening, just take a look at a chart of NOC from, what was it, early 2021 or so, to recently. I mean, it's nice. It's like, let's see here. I don't know, just round numbers on a sloppy old Yahoo chart, like maybe high 200s, low 300s, 320 or so, and then they've got a peak of 549 in October 22. So pretty, and again, like you're making this huge return, but you weren't basically buying Bitcoin or some money losing tech thing in ARK.
Right.
That's cool.
Right.
Yeah, to me, that's another example of when you pick a good company and then the macro
takes care of itself.
Like you said, the war, the macro, eventually those things are going to happen. And so
right,
the companies, the good companies within that will benefit the most. One thing I did want to ask you about is inflation. We talk so much here about like CPI and all this data. Everybody's an expert, but where do you? I know you guys you and the team have done a lot of work on inflation data, and just where do you see that going specifically? I know you've written about the housing data and maybe why that will be sticking around for a while. Those higher numbers. Maybe just explain to people how what you're thinking is there and what maybe we should expect from the inflation numbers.
Well, inflation, let's go back. Again, I think it's always important to have the historical perspective and look at the data. So I went back to 1960 and looked at M2, which is a measure of the money supply. And so in the 70s and early 80s, that was the that was the stagflationary environment. You had high inflation, and sure enough, M2 increased by over 150% in the 70s. That was a 9% annualized increase. And then even in the 80s, M2 was up 100% or over 100%. And then you had a moderation in both M2 and inflation, obviously. And what's interesting is in the 2010s, you had M2 was up 73%, which is only a 6% annualized increase. And you had that was following. Everyone thought that QE was going to be really inflationary, and basically you just didn't see the increase. A big increase in M2. And now you have had the fiscal stimulus in response to the pandemic, and so now M2 is up 38% since 2020. And you had that big year over year, it was up 30%. That's when we had this inflation shock. And now what's happened is M2 is about to go negative year over year. And so that's sort of the context that I'm looking at. If M2, if we don't have a decade of M2 increasing by 150%, I don't think we're going to have anything close to the 1970s. I don't think we're going to have a stagflationary environment. And I think policymakers and the politicians are pretty clueless, but I don't think we're going to make, I don't think we're going to make these mistakes. I don't think we're going to see M2 increase by 150%. And so that's sort of where I'm at with inflation. And then I don't want to get into like all the details with shelter inflation and goods and what's, there's, what's sticky and what's not. But I think that inflation is going to slowly decline to at least below 5% this year. I think the Fed is eventually going to, Fed is eventually not, going to hold their hikes. And I think looking back at a couple of years, I think that it's not out of the question that we'll look back and we'll say, well, there was some the transitory nature of inflation actually, there was some truth to that, right? And the supply shock and the war, how oil spiked after the Russia invaded Ukraine, and that sort of threw a wrench into the works. But I think that, and that's part of the reason why I'm bullish on bonds, I'm bullish on treasuries and MBS. I don't think that corporate bonds are the place to be yet. We haven't seen credit spreads blow out yet, and we might. So, so based on my inflation outlook, I'm bullish on bonds, on treasuries.
Yeah, good play. I mean, it's really interesting too to be bullish right now because let's face it, Treasuries scared the daylights out of the entire world in 2022. Deutsche Bank had that data that said it was the worst performance going back to 1788.
Yeah.
I love the Deutsche Bank data. It's like centuries, and they have it for other bonds too. It's funny.
Pen and quill, I always like to think about. Yeah.
Yeah. So that's actually, I mean, if we're heading into a period such as you suggest, of course, like bonds would be a classic move right now, right? But after the year we just had, it may seem slightly bold, if not more than slightly bold of you.
Right. Well, after the worst year, so it's the worst year for the Bloomberg aggregate, which used to be the Barclays and the Lehman aggregate. But it's the worst year for that index, the overall bond market index, going back to 76. And people are shell shocked, but I think it's bonds can now, if the inflation shock is over, then now bonds can resume their diversification, properties, and they can be a ballast during rough times in the stock market.
So, as a cyclically aware guy, part of the argument here among bond bears is bonds move in enormous long cycles, right? 1946 to 1981, huge bear. 1981 to the present, just say, or recently, huge bull market. Now transition to another long, decades long bear. You don't see it though.
That's the risk, and there's always risk. But I just think that the bond market tends to have these long-term trends, but there's also these long-term macro trends in its favor, where you have such as demographics and technological advancement, which is, I think, is sort of constant, but I think it's accelerating in the sense that there's going to be less demand for manual labor, and now even knowledge workers and things of that sort. So I think that there's a lot of inflationary pressures that that are there's a lot of disinflationary pressures, and plus now the U.S. is we've had our energy renaissance, and that's another big difference between now and the 70s, where it's we have these vast oil and gas resources that we're finally exploiting. So that I think that does keep a long-term lid on energy prices.
Mm-hmm. Yeah, and to be fair, like if you take, I don't know, care how you do it, do like constant maturity and just pick your duration or whatever. There are multiple in the long bear cycle. There's like multiple bull runs. It's not these aren't straight lines, up or down and to the right. So you can be even though if you look at I don't know, just pick on the 10-year, 3.5% might not seem like the greatest deal in the world. It could still be a wonderful ride to 2.5% or something, right?
Right. Exactly.
All right. So we've actually been talking for quite a while, Alan, and I've enjoyed it quite a bit. So it's time for my final question. Same final question for absolutely every guest, no matter what the topic, even if it's a non-financial guest. So the question is simple. If you could leave our listeners with a single thought today, what would it be?
Well, I think I touched on it, but there's a quote from Shelby Davis, who's a highly successful but not that well-known investor. And Davis said something like, "You make most of your money in a bear market. You just don't know it at the time." And now that's true. But only if you're actively looking for opportunities and not stuck at a defensive posture. And we're in a bear market. Maybe the S&P 500 makes new lows. Maybe there's a hard landing. But you can't let these risks scare us away from looking for opportunities. And that's my message that I said throughout. Always be looking for opportunities. And because I think a couple of years from now, I think most investors are going to look back to the market and see a whole bunch of stocks that they wish they bought in 2022 and 2023.
Great point. Thanks for that. We interviewed Chris Davis on the show
a
while back.
That's
that was
great.
A good one. Yeah. A great guy, great talker, really, really gregarious and brilliant, of course. But Alan, thanks a lot for being here. I'm glad we finally got you on the show.
Dan, it's been a pleasure. Thanks for having me.
Two legendary market experts are stepping forward to warn we're in the earliest stages of what they call the Great Unraveling, a specific event starting to take root in America that's behind the recent crash in stocks and the record inflation you're seeing. But they worry it's about to get even worse. And many of the things you take for granted are due to a big disruption in the months ahead. Your Social Security benefits will likely be slashed. Your taxes are probably going way up. And many of your investments are likely to continue falling, meaning if you think you've saved enough money to retire, you're probably going to need way more money than you thought. Your personal success all comes down to how well you understand what's heading your way. This is why I strongly encourage you to read about their warning on the show for a long time. It's all spelled out in a free report we put together about the Great Unraveling. Analyst and get investor. The facts yourself. Go to www.2023unraveling.com. Quite exquisite. To get your free copy of this report. About the process and you can learn how to get their full playbook to prepare for what's coming. Again, that's www.2023unraveling.com for a free copy of this new report.
Agreed. It was. I enjoyed it. Listening to him kind of run through all things macro and micro, and I mean, I think his point's a good one, just as far as where his outlook is looking forward. He's kind of neutral-ish on the market, but within it, there's areas of opportunity, while also being aware of the risks, downside risks ahead. So I think that's all you can really do in this, and you're not going to exactly predict what's going to happen, but I think you could get a good sense of how Alan approaches things and what he brings to our, like he said, our flagship publication, which is Stansberry's Investment Advisory. I'll do a quick plug. If it's kind of our introductory sort of service where if you're looking to see more detail and recommendations of what we're talking about, it's a good place to start. It's probably the most affordable thing you could start with.
Yeah, that's a great point. And that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody who might like it, tell them to check it out on their podcast app or at investorhour.com. Do me a favor, too. Subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.